Hello, friends. The tax and benefit system in this country does not treat everyone the same. Depending on your exact age, your income, and whether you own or rent your home, the rules that dictate what you owe are completely different. And right now, in 2026, people in every relevant group are losing money or making irreversible financial decisions simply because nobody sat down and explained the rules for their specific case. If you blindly assume the government will notify you when a bill goes away, you are going to overpay for the rest of your life. Find your group, listen to what applies to you, and by the end of this video, you'll know exactly what to check and what to do about it. Before we dive in, if you're not subscribed to this channel, please do that right now and turn on the bell. Here is why it genuinely matters. The rules around these exemptions change constantly. Tax laws sunset, Medicaid premiums recalculate, county thresholds shift, and when they change, the relevant agency does not personally notify people in the mail. The gap between finding out in time versus finding out after the fact is the whole point of this channel. Hit subscribe, turn on the bell, and let's get into it. If you are currently 65 or older, you need to understand a massive structural shift in how the government views you. The day you cross that 65 threshold, you are legally exempted from an entire category of taxes, premiums, and fees. You are quietly pulled out of obligations that younger, working-age people are statistically still paying in full. But the single most expensive mistake you can make is assuming that those agencies will just automatically stop billing you. They absolutely will not. If you are legally entitled to an exemption, you have to file a specific piece of paper to actually claim it. The county assessor does not send you a birthday card telling you to stop paying your property tax. The IRS does not automatically adjust your withholding, so you keep more of your pension. If you do not file the form, they will happily cash your check forever. That gap between qualifying for a break and actually claiming it is where millions of seniors are bleeding out their retirement savings. Let us start with the single most critical update for the 2026 tax season. This is relatively new, and if you are not paying attention, you are going to miss it entirely. If you file a federal income tax return and you were 65 or older by December 31st of 2025, there's a massive temporary deduction that you must manually verify on your return. Thanks to a legislative package passed in July of 2025 known as a One Big Beautiful Bill Act, every single eligible senior gets a $6,000 bonus deduction dropped straight onto their tax return. If you are married and filing jointly, and both of you are over 65, that is a $12,000 combined deduction. This is not a replacement for your standard deduction. It stacks directly on top of it, and you can even claim it if you itemize your deductions. But there are strict income limits you must understand. If your modified adjusted gross income is over $75,000 as a single filer or $150,000 as a married couple, that $6,000 deduction begins to phase out gradually. If you earn over $175,000 single or $250,000 joint, it disappears completely. If you blindly hand your paperwork to a busy tax preparer or click through cheap software without verifying your exact birth date and the specific $6,000 line item, you are going to surrender hundreds of dollars in federal taxes that you simply did not owe. If you are in the 22% tax bracket, missing a $6,000 deduction costs you $1,320 in real, spendable cash. When you review your 2025 return filed in early 2026, you must visually confirm this deduction was applied before you sign the bottom line. And that brings us to the second, longest-standing piece of the tax code that works directly alongside that new law. Even before the 2025 legislation, the IRS has always maintained a separate, additional standard deduction specifically for seniors. It is one of the oldest and most frequently missed tax breaks in the system. For the 2026 tax year, if you take the standard deduction, the IRS grants you an extra $2,050 if you are single or a head of household. If you are married filing jointly, it is an extra $1,650 for each qualifying spouse. If you are legally blind, those numbers double. If you stack the base standard deduction, the new $6,000 bonus deduction, and this $2,050 senior add-on together, you are looking at a massive wall of untaxable income. Let me paint a clear picture for you. If you are a single senior in 2026, combining the $16,100 base standard deduction, the $2,050 senior deduction, and the $6,000 bonus deduction, you can shield nearly $24,000 of income before paying a single dime in federal tax. If you do not adjust your tax withholding on your pension or your Social Security checks to account for this new math, you are loaning the government your money for free all year long. The next time you sit down with a professional, you must ask if your monthly withholding need to be dialed back, so you get your money now, not as a refund next year. Now, let us move away from federal taxes and look at the absolute largest recurring bill most people face in retirement. If you own a home, your property tax bill is likely destroying your fixed budget. But there are 3 specific legal shields you can put between you and the county assessor, and most homeowners are missing at least one of them. The first is your basic homestead exemption. If you live in the home as your primary residence, almost every state offers a baseline reduction in your assessed value. In Florida, that takes up to $50,000 off your home's taxable value right out of the gate. In Texas, it is $100,000 off the school district portion of your taxes. But if you assume this happened automatically when you bought the house, you are likely wrong. In most jurisdictions, you must file a 1-page form by a specific spring deadline. If you do not file it, you pay taxes on the full, unshielded value of the property for absolutely no reason. The second shield applies strictly to the 65 and older group. This is the senior exemption. In states like Texas, the moment you turn 65, you qualify for an additional $10,000 reduction specifically on the school district portion of your tax bill. In Florida, depending on your county, the senior exemption can stack another $50,000 on top of your base homestead exemption. That essentially doubles your tax relief overnight. If you are sitting in a paid-off house and assuming you make too much money to qualify, you need to check your local laws immediately. Many states have absolutely zero income tests for this age-based exemption. If you are 65, you get it, but the county will not automatically apply it to your bill. You must pick up the phone, call the assessor's office, and ask for the senior exemption form by name. The third and most powerful property tax shield is the senior assessment freeze, sometimes called a tax ceiling. If you live in a neighborhood where property values have skyrocketed over the last 5 years, this is how you survive. When you turn 65 and file for the freeze, the county legally locks your tax liability at the exact dollar amount you paid the year you applied. In places with aggressive property tax caps like Texas, your school tax ceiling is frozen permanently. If your home's value triples over the next 10 years, it does not matter. The county cannot force you out of your home with spiraling tax bills because your baseline is locked in stone. But again, if you do not actively file the freeze application, your taxes will continue to rise every single year along with your home's value. And if you are a renter watching this, do not tune out, because this applies to you too. Your landlord pays a property tax bill on the building you live in. When their property taxes go up, they pass every single dollar that increase straight into your monthly rent. When property taxes are frozen or reduced across a community through senior exemptions, it stabilizes a local housing market, meaning your rent stops climbing as fast as it otherwise would. Let us switch to the money quietly vanishing from your Social Security check before you even see it. If you are enrolled in Medicare Part B in 2026, the standard monthly premium is exactly $202.90. That is up nearly $18 from last year, and it is pulled directly out of your benefits month after month. But if your income falls below a certain threshold, your state government is legally obligated to step in and pay that $202.90 for you. The program is called the Medicare Savings Program, or MSP. The most common tier is a Qualified Medicare Beneficiary, or QMB program. For 2026, if you are a single filer with a monthly income under $1,330 or a married couple under $1,804, your state will wipe out your Part B premium completely. It will also cover your Part A and B deductibles and coinsurance. There are 2 other tiers, the SLMB and QI programs, which have higher income limits. If your single income is up to $1,796 a month, you can still get that $202.90 premium paid for. If you qualify for one of these programs, you are keeping an extra $200 in your pocket every single month. Millions of seniors qualify for this program and never apply because they assume their modest savings or paid-off house automatically disqualifies them. Do not disqualify yourself. Several states have completely eliminated the asset test for these programs. Call your local state health insurance assistance program, known as SHIP, and demand an MSP screening. It takes 10 minutes. It is completely free, and it can fundamentally change your monthly budget. If you pick up the phone to call ship, you must also ask them to screen you for extra help. Extra help, officially known as a low-income subsidy, is a federal program that attacks the cost of your prescription drugs under Medicare Part D, if you qualify. And many of the exact same people who qualify for a Medicare Savings Program also qualify for this. It drastically lowers your drug plan premium, shrinks your annual deductible, and caps your copays at the pharmacy counter. In many states, getting approved for a Medicare Savings Program enrolls you in extra help automatically. If you are walking out to the pharmacy with hundreds of dollars in out-of-pocket costs every month, you must pursue this application. It is one phone call to unlock two of the biggest healthcare cost breaks in the entire system. Beyond taxes and healthcare, there are utility exemptions designed specifically to keep your fixed costs low. If you are struggling with basic communication and energy bills, you need to stop carrying the full burden. The Federal Lifeline program provides a direct $9.25 monthly discount on your phone or broadband internet service. Many states stack their own telecommunications discounts right on top of that. If you combine that with a Low-Income Home Energy Assistance Program, or LIHAP, you can receive direct financial grants to cover the cost of heating and cooling your home. I know what some of you are thinking. $9 a month is not going to change your life. But you have to view this holistically. It is one more recurring bill that the system has already decided people in your situation should not have to carry alone. If you let $9 a month slip away on your phone bill, and $200 a month slip away on Medicare, and $1,000 a year slip away on property taxes, you are bleeding out your retirement savings entirely by accident. Let me give you a few bonus moves specifically for homeowners with real assets. Because if you fall into this category, these strategies are worth more than almost everything else on this list combined. The first is a property tax deferral. In a number of states, once you reach a certain age, usually 65, you can choose to legally stop paying your property tax bill entirely. You just stop paying it. The state places a lien on the property, and they simply settle up the debt later when the home is eventually sold or passed on to your heirs. You keep your cash flow in the meantime, which can be thousands of dollars a year, allowing you to live comfortably in your home without the stress of an annual tax bill. The second bonus move is a surviving spouse carryover. When one spouse passes away, those valuable senior exemptions and tax freezes do not automatically transfer to the surviving spouse in many jurisdictions. Families lose these massive tax breaks completely by accident during the worst possible year of their lives. But if you file the right paperwork, the surviving spouse can often keep the deceased spouse's exemption alive, preventing a catastrophic jump in the tax bill. The third bonus move is one people often dismiss until they actually add up the numbers. In a number of states, once you hit a certain age, your annual vehicle registration fees or excise taxes get reduced or waived entirely. It might seem like small money, maybe $50 or $100 a year, but it is your money. It is sitting there waiting to be claimed, and all you have to do is check the correct box at the DMV. Let me bring all of this back to reality with a quick story. I once heard about a woman named Margaret, 72 years old, living as a widow in a paid-off home that had quietly doubled in value over the years. She was getting by strictly on her Social Security check and a very small survivor pension. When a professional finally sat down and looked at her situation, they found a disaster of unforced errors. She was paying the full $202.90 Medicare Part B premium every single month. She was paying the full, unfrozen property tax bill on a home that had appreciated rapidly for a decade. And she was paying more in federal tax than she actually owed because a tax preparer had never applied her senior standard deductions or adjusted her withholding. All three of these massive expenses were draining her account simultaneously, and every single one of them was something she had the explicit legal right to stop paying. So, they filed 3 simple forms: a Medicare Savings Program application with the state, the senior exemption and assessment freeze with her county assessor, and a corrected federal tax return claiming the full scope of her senior deductions. Nothing about Margaret's actual life changed. She did not move into a smaller house. She did not sell her assets. The only thing that changed was how much of her own money stayed in her checking account at the end of every month. She wasn't gaming the system or finding a loophole. She was simply, finally, claiming the exemption she had already earned over a lifetime of doing everything right. That is the entire point of everything we are discussing today. Being legally exempt and actually keeping your money are two very different things. The only bridge between them is the form, and the government is not going to build that bridge for you. If you feel completely overwhelmed by the tax forms, there's a final safety net you must utilize. If you have been avoiding claiming your $6,000 One Big Beautiful Bill deduction or your extra $2,050 standard senior deduction because you cannot afford a CPA, you do not have to pay anyone. The IRS funds two completely free tax preparation programs specifically for you. Tax counseling for the elderly, or TCE and AARP Tax-Aide, are staffed by IRS-certified volunteers who specialize in senior tax returns. They know exactly where the new deductions are located on the forms. They will sit down with you, prepare your return, apply every legal exemption you are entitled to, and file it electronically at zero cost to you. For most of you, the cost of finally catching every one of these exemptions is nothing at all. So, here is a summary of exactly what you must do this week to stop the bleeding. If you file federal taxes, visually verify that your 2025 return includes both the standard $2,050 senior deduction and the temporary $6,000 bonus deduction, so you do not hand the IRS a free loan. If you own a home, call your county assessor today and demand to know if the Homestead Exemption, the senior exemption, and the assessment freeze are actively shielding your property value. If you pay a Medicare Part B premium, call your local SHIP office and ask to be screened for the Medicare Savings Program and extra help to get that $202.90 put back into your Social Security check immediately. And if your monthly utilities are stretching your budget, submit an application for Lifeline and LIHAP to lock in your energy and telecommunications discounts. Subscribe, share this with someone you know who's in one of these groups, and I'll see you in the next one.